So here we're going to walk through a basic FX trade, just to give you the idea, obviously, behind the concept of how it all works and the logistics behind it. Firstly, this is what we'd refer to as trade board in the industry. You can obviously use order tickets as well. This is just a really good visual representation for my example as to how the pricing for an FX trade works. You can see the top left here, we're going to be trading the Aussie dollar or Australian dollar versus the US dollar. So our base currency is going to be Australian dollars and our quote currency is going to be US. At the top here, they'll usually denote the base value, obviously, of what it is you're trading. Then with the pips usually highlighted much larger because that's going to be what we're trading on. There's our spread, which in this case is going to be 1 pip, for example. So a pip is just a fraction of a cent. In this case, we want to buy, unlike equities trading where you buy a number of shares, or let's say an index trade where you might buy a number of contracts. When we're trading FX, we trade on a value basis. So we want to then purchase, for example, 100,000 Aussie dollars versus the US. So moving down, we've got now our opening purchase price, as we had the offer there, was 101.52. So we're buying US dollars versus the Aussie at 1.0152. The quantity we want to buy is 100,000. So we want to buy $100,000 worth of Aussie against the US. A commission payable here is $10. Now the reason there's commission payable, a lot of market makers offer FX with a much wider spread. Now that wider spread therefore will pay the broker their commission. Even though they call it commission free, you are actually paying for it. That spread being widened, as an example, let's say you had $1 million position in this Aussie US and the spread was actually 2 pips instead of 1. That extra pip either side would actually end up costing you the equivalent of $100 just on if you had $1 million position. So the I think I pay about $30 per million, and again, $1 million in Forex trading isn't overly large. I know for some people it might be, which is why I'm sticking with a much smaller trade for now. But with the leverage available, it is quite easy to achieve. So my minimum commission here is going to be $10 for my $100,000 trade. Again, we're going to go $100,000 Aussie is the total exposure we're going to have to the market, with a 1% margin, meaning for that whole $100,000 position, I'm only outlaying $1,000. So our initial outlay is going to be $1,000.10. Now let's say we've held this position for a while. We're now back up to the trade board. The value of the Aussie dollar against the US has gone up a cent, so it's gone in our favour to 102.53 is the offer and 102.52 as the bid. So in this case we want to sell, so we're going to sell at this 102.52. So coming back down, our closing price 1.0252. Our quantity we're selling is worth the equivalent of 101,000, okay, because it's actually gone up. So we want to exit this position. We want to close the position of the $101,000. Commission again is going to be that $10. So total outlay is $1,020, and our gross profit on that, so that 1 cent movement on 100,000 is $1,000. If we had a $1 million position, that'd be far greater, obviously, which would be brilliant. And in this case, our net profit is going to be $980 because we're going to take away the $20 for commissions. So our return on investment is rather handsome at 96.08%, which just shows you the power of leverage with FX. Keeping in mind, if that position went down a cent, so instead of 101.52 where we bought it, it was at 1.0052, we would have lost 1,000. This can move quite quickly. To give you a good example, per pip that would move on a $100,000 position, we're going to make or lose $10. So quite a bit of leverage. If we take that up to $1 million position, as kind of explained with the commissions, you'd be looking at $100 a pip movement, which is really quite good. Markets are very, very liquid, easy to get in and out of, and it just shows you the power of FX CFDs.